Good evening, friends. Hope you all are well and doing fine. Recently, we released our annual yearbook, wherein we articulated what happened in 2022 and what do we expect from the markets and economy globally and domestically. Uh, what we think about the markets and economy going forward. It's well articulated. Now, we are in the last part of the last period of the year or a quarter of the year. And generally, when it comes to last quarter, the saving of tax is paramount on people's mind. How do we plan our taxes or how do we save on taxes? And when we have this ATC option, there are various options available to us as an individual investors. We have PPF, we have insurance, we also have ELS schemes, uh, which we have already shown on the screen, HDFC TaxSaver, which has been in operation for last more than 25 years. So multiple options, and there is always a dilemma or confusion mind what to choose from. So before we begin today's session on the understanding of markets, economy, and the product in which is there before you, I thought let me give an option or understanding of what an ELSS scheme is all about. ELSS as a scheme hasn't been in operation or under the guidelines of the government of India has been in operation for more than now nearly 3 decades. And HDFC TaxSaver, which is our fund, which has been in operation for more than 26 years. And right now on your screen, you can see that if you would have saved, say, 1 lakh rupee a year, every year for last 26 years, your 26 lakhs would have become in PPF because PPF also has a declining interest rate regime, starting with double digit more than 2 decades ago, and today it's roughly around 7%. It would have cumulatively become close to 92, 93 lakh rupees. And the same amount of money, if you would have invested maybe in the market, in the broader market, we say NSE 500, which is a portfolio of large, mid and small, it would have become roughly around 3 crore rupees. And pure large cap, Nifty 50, it would have been around 2.5 crores. So this is where I'm referring to. But had you put that money in HDFC TaxSaver, which is a portfolio of actively managed stocks, that same 1 lakh rupee invested for last 25, 26 years would have been close to 8.5 crores. So that's the kind of wealth you could have created by just staying invested or investing regularly in HDFC TaxSaver for last 25, 26 years. Now, the only difference here is if you see PPF, the value of money keeps on growing every year. There is not a single year of peak. But when you look at, say, HDFC TaxSaver, because it's a market-linked product, it has its own ups and downs. For example, if I look at 2008-9, if I were to look at the 1 crore 69 lakh in 2008, because of this global financial crisis, next year became 1 crore 9 lakh. So there was a dip of nearly 60 lakh rupees in a year's time. But then with the growth in economy, with the economy recovering globally, domestically, it again caught up and became 2 crore 32 lakhs. This is what I'm referring to. Similarly, if I go to this COVID year, the 6 crore value dipped to nearly 4 crore rupees. And again, with recovery in the economy, it again came back and it is close to 8.5 crores. So yeah, there is a portfolio volatility associated with equity markets. But for patient investor, actually, it has been a very rewarding experience over the years. And that's what ELS is all about. So when you are contemplating various options, you need to keep this in mind. One which grows linearly, like a PPF because of the steady interest rates. But the wealth compounded over the period, over the years, is significantly lower than what you can create through actively managed stock. Now, this is a pretty long term, but when I even look at short term, if I look at just last 1 year or maybe 2 year period, what we find in HDFC TaxSaver as a category, as a fund, has generated 11.5% return, whereas the category average, all ELSs put together in the industry operating is roughly around 3%. We have created outperformance of 8.5%. And when I look at its benchmark of NSE 500, it also has grown by only 5.3%. It's against 11.5%. So HDFC TaxSaver as a scheme has done phenomenally well when compared to category average and its benchmark. Also, the same story is there. in 2-year period also. 3-year done better than the category average, almost similar to its benchmark and catching up in terms of performance. So this is how HDFC TaxSaver on a very short-term basis. I have already also shown you how it has performed over a longer period of time, so more than 2 decades. Currently, this scheme is managed by Roshi Jain, our senior fund manager, who is part of this call, who will be explaining us her thoughts on the market economy and how the portfolio is positioned right now. So you have a fair chance and idea to understand and know what you can expect from the portfolio going forward. But when it comes to various portfolios managed by Roshi Jain, this is TaxSaver is one such scheme. There are 2 other schemes that she has been managing, which is Focus 30 and FlexiCap. And here both sides you can see in 1 year, it has performed 18.3 against the Nifty 500 benchmark of 4%. And FlexiCap also, it has done 18.3 as compared to benchmark. So I think more or less, if you see as compared to its benchmarks and peer category, all the 3 portfolios managed by Roshi have been doing very well. And therefore, it will be worthwhile to know from her what are her thoughts. And HDFC TaxSaver, as I again go back to the same thing, that last quarter of the year, and everybody would like to evaluate various options, why they should consider HDFC TaxSaver as one of the preferred option as far as investment under Section 80C is concerned. With me on the call is Ram Kumar, my colleague, who will be helping me moderate the call towards once Roshi is done with her opening remarks, and the floor will be open for question and answers. So Roshi, on the call are our distributors and investors, and without much ado, you can actually take over and start giving your opening remarks, and then we will have a question and answer thereafter.
Thank you. Thank you, Ashok, and thank you to all the participants on the call. Pleasure to be talking to all of you. So I'm going to share a presentation which will set the context, give a sense of economic drivers as well as positioning of the fund. I think equities over the long term reflect corporate earnings. So let's sort of take a dive into some of the economic catalysts for the country as well as for the various sectors. So this is a sort of snapshot of the GDP growth for the country over the last 4 decades. And the point that I would like to make is that given the kind of volatility that we have been seeing lately, I think the question uppermost in everybody's minds is that how does India deal with these challenges? What are the risks as well as opportunities out there, and how should one be positioned? And I think cutting through the noise, history sort of gives us a perspective of the trajectory of the Indian growth rate. And you will see that over the last 4 decades, there have been a plethora of domestic as well as global events, each of which appeared to be quite unprecedented. And yet the economy has stayed extremely resilient, growing at around 6% in real terms. And this has happened as the economy has been growing. So, despite a growing size, we have been able to maintain the growth rates. And in our view, what will drive Indian growth over the next few years, and why we feel confident about the resilience of growth of the Indian economy is sort of encapsulated here. We will dive into each of these factors in a little bit of detail, but in summary, I think the few factors which will help Indian growth over the next few years relate to one, an increase in the manufacturing intensity in the economy, driven by both policy measures as well as shift in supply chains. We expect the formalization of the economy to continue to drive growth. We've seen corporate balance sheets delever, and that sets the stage quite well for an improvement in private sector capex. The banking sector is fairly robust, having come through an NPA cycle. We are also in the midst of a housing cycle recovery, in addition to, of course, continued infrastructure investments led by the government. Also good to take a rain check of the risks that we should be cognizant of. One is, of course, India runs twin deficits. So this is something to keep at the back of our mind. We are seeing globally an inflection in interest rates as well as inflation. Over the last decade, we've been in an environment of low interest rates and inflation. We are seeing an inflection there, so something to sort of be cognizant of. Um, and Of course, markets have done well. Indian markets have done well, and valuations are no longer as attractive as perhaps they were. So we will go into some of these aspects in a little bit of detail. Let's first look at the potential tailwinds. We are long-term equities is a long-term instrument, and therefore I think we need to look at some of the longer-term drivers of the economy. The Make in India theme is something that we think will sort of benefit the Indian economy from the perspective of greater value addition. And this is driven both by policy impetus in the form of PLI schemes by the government, as well as favorable tax regimes, and also by the manufacturing cost competitiveness, in addition to several companies wanting to reduce the dependence on China as a supply chain source. A combination of that de-risking of supply chains out of China, as well as a favorable cost base, as well as government policy regime, makes us hopeful that India will see a shift or will see favorable manufacturing intensity going ahead. As you can see in the chart, India's share in global merchandise exports is a fraction of what it is in China, and the headroom for growth clearly is significant. Even a 10% shift out of China over a period of time still means an opportunity for India to nearly double its share in the global merchandise exports. One of the things which also works in favor is the competitiveness in terms of manufacturing wages. As you can see in the chart, we compare extremely favorably now on manufacturing wages versus China. And the other factor going for us, of course, is that we still have a working age population, which is increasing, whereas China's total headcount is now on the decline. The ability of the private sector now to participate in capex, we also think is now it's in a favorable position. We think that the NSE 500, which is the broad-based index, the capex to GDP has bottomed, and we are of the opinion that we should start to see an upturn in terms of the corporate private sector GDP. The corporate sector balance sheets are now extremely robust, and this gives the ability to corporates to embark on private capex. The opportunity available from stepping up manufacturing intensity, of course, is available. And if you couple that with healthy balance sheets of the private sector, that gives a good backdrop for private sector capex to pick up. The banking system is also fairly robust, and therefore in a position to sort of support the growth aspirations of the country, both from a capital availability perspective, as well as the strength of the banking balance sheet with record low NPA percentages. This slide shows you the robust data points with respect to the banking sector. And therefore the ability of the banking sector to now support growth. The housing sector also seems to be in revival mode. We've gone through a period of consolidation on the housing sector. And going ahead, we feel that the affordability of the sector, the affordability of households to own a house is reasonably good. The chart on the top gives you a sense of the affordability ratio. And we are also seeing increased transparency on account of regulatory measures such as the RERA Act, which has renewed buyer confidence. Housing is a very important part of gross capital formation and one of the various components of fixed asset investment, the others being private sector capex as well as government infra, and the revival in housing should support faster growth. And finally, just a quick snapshot of how India compares globally. I think the key takeaway really from this chart is that we have been growing without necessarily increasing our debt intensity. You will see that most countries, advanced emerging markets, as well as China, over the last few years have seen a significant increase in debt intensity, while India has grown by keeping debt intensity almost stable. And I think that is an extremely positive aspect to take away with respect to India's macroeconomic stability as well. Let's quickly go through some of the potential headwinds. India, as you're all aware, runs both a fiscal deficit as well as a current account deficit. So in the event that we start to see a significant global slowdown, the exports could be impacted. Similarly, if we see some increases in some of our imports, then higher oil imports, of course, has an impact in terms of a higher current account deficit. So this is a risk that we need to be cognizant of. Also, fiscal deficit, the government is, there are targets under the FRBM Act, and given the kind of fiscal deficit that increase that we had seen around the COVID times, the government will be moving towards fiscal consolidation, and therefore not too much headroom available in terms of government support to growth in the event that we see some growth shocks in the economy, either for domestic or for global reasons. There's a lot of talk around quantitative tightening, and this is one of the risks as well. We've seen increase in interest rates globally to counter inflation, and we've also seen central banks unwinding some of the liquidity that was infused during the COVID period. Of course, the increase in liquidity in the economy helped move asset prices up, and as that unwinds, there will clearly be an impact on asset prices, and this is something to be cognizant of. While we have seen inflation come off from the top, there are still factors which make it appear that inflation could be sticky. We have seen it come off from the peak, yet it is at elevated levels. And some of the factors could be around historic underinvestment in some of the commodity-intensive sectors, oil and gas, as well as other commodities. And therefore, as the supply response comes with a lag, we could see sticky inflation in some of these components. Also, in the advanced world, we have seen that the stickiness in inflation is also on account of sticky wages, and therefore, given the low given that we are seeing that sticky wages on the services side related to the wages, it is possible that we could see that sort of stretch for a little bit before coming off. The US job market does remain tight in spite of the news around tech layoffs as well as the rising interest rates. And the final point is with respect to valuations. We are trading at above average valuations. The chart on the left shows you the Nifty 50 valuations over the last decade. The chart on the right shows how much of a premium we are trading with respect to the MSCI emerging market. These are just some charts to show the mid-cap as well as small-cap valuations. I think really the message that I want to convey amid all of the opportunities that we talked about is that global slowdown and inflationary pressures can impact the near-term growth outlook as well as the profitability of companies. However, let's not lose sight of the longer-term opportunity that exists, which is that we are seeing, or we are likely to see a pickup in private sector capex. rebound in the housing cycle, as well as sustained increase in personal incomes and consumption, just given the kind of demographics that we have, as well as the opportunities around the manufacturing, as well as the capex side that I talked about. Low corporate and household leverage, as well as a robust banking sector, bodes well for the economy over the medium to long term. But I think it's important that we stay disciplined around sector as well as stock picking, given that we are no longer in an environment of unlimited liquidity and high cost of capital driven by higher interest rates, as well as liquidity tightening, can have an impact on valuation multiples, besides, of course, impacting the profitability of levered companies. The message, therefore, is that we need to participate in India's long-term opportunities, but be disciplined about stock selection as well as sector selection. Let me quickly go through the investment framework that we adopt for the TaxSaver fund before I go into the sector positioning in the fund. So really, there are two key pillars that we are focused on in terms of the framework for the fund. The first is that we do want to buy good quality growth companies. We want to buy companies which are fundamentally strong, which are competitively placed in the industry. Stock selection will, of course, consider the stage and trajectory of the industry cycle, but we will take a risk-adjusted view so that we position ahead of the market. We are looking for companies with strong management, with an ability to capitalize on opportunities, but at the same time, manage risks as well, given the kind of volatile world that we are in. As also having a superior track record on corporate governance and transparency, sensitivity towards ESG, as well as minority shareholder interests. So we want to buy these good companies, but maintain the valuation discipline. We think that in an environment where liquidity is getting tighter and where cost of capital is going up, the valuation discipline is something that needs to be re-emphasized. And for us, we do take a holistic approach to valuations without relying solely on traditional parameters like price to earnings or price to book. Valuation approach will also be strategic and long-term, in line with our approach that we are long-term investors in the market. This is how the TaxSaver portfolio looks like. We have a total of 35 stocks, AUM of about 10,000 crores. It is large cap focused at this point in time. Predominant exposure or overweight towards the large cap companies in the index. Current cash holding in the fund is about 4%. And if you look at the top 10 holdings, you will see a good mix of both domestic cyclical sectors, as well as some more defensive sectors, in order to balance out the volatility that could exist in the near term. From a sectoral perspective, we are overweight the financial space, where we think that credit growth and a benign credit cycle will continue to benefit the sector, and over the long term, greater financialization of savings, which is the shift from physical to financial savings, will continue to benefit the sector. We are positive on the industrial space. I talked to you about the shift in global supply chains that we are seeing, the PLI schemes, government focus on ensuring self-reliance in manufacturing. We think that those themes will continue to out over longer term, and we are therefore overweight on the industrial sector. We are positive on the healthcare sector, where we think that it's a relatively defensive sector. There are the domestic market is fairly stable, offering good growth opportunities. There are selective opportunities in the export markets as well. There's a significant improvement in capital allocation. So we are positive on the healthcare sector. We are positive on the communication services or the telecom sector, where we believe that cash flows are defensive. And in times like this, it is important to be having that cushion of stable cash flows. We are positive on the utility sector as well for the same reason, defensiveness in cash flows. We are neutral on the information technology sector. Our underweights are largely around the energy and materials sector, there are stock specific reasons, but also in general, I think we are seeing a global growth slowdown. And in such a scenario, we think that some of the global facing sectors like materials and energy uh, could have could be faced with some near-term challenges. Consumer staples is a sector where we are underweight as well because of valuation as well as growth and margin concerns. So this is how the portfolio looks at this point in time in terms of its overweight and underweight positioning.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.